All right, all right, all right. Good morning. Okay, so this morning we are moving on to the principles of taxation under the life insurance module. And I'm happy, super happy with the progress we are making. We are moving according to plans and schedule. All right. So without further ado, I'm going to start sharing my screen now for us to jump right into it. All right, principles of taxation. And in chapter one, like I told you guys, this taxation framework will have just 4 chapters. And it's part of life insurance module. So when you are writing your certifications and your provincial exams, you're not going to get a different exams for principles of taxation. It's going to be all part of your life insurance module. All right. So moving on, taxation framework. Insurance agents should have a basic knowledge of the Canadian tax system to better serve their clients. This is referring to you and myself. Okay. However, it is essential that agents recognize that this chapter will not make them an authority on all matters pertaining to tax. At times, they will need to call on the expertise of an accountant to better serve their client. Of course, you see, the understanding of this principle of taxation is not to make us a tax consultant. Okay? No, it is not. And we also have to know that when it's time to recommend to our client to seek the advice of an accountant. All right. All right. Moving on to taxation and the practice of life insurance agents. Let's talk about this one. In Canada, taxes are mandatory and levied on individuals, trusts, and corporations by 3 levels of government: the federal, the provincial, and the municipal. Okay? These are the 3 levels of government. Government uses tax revenues to pay for such things as old age security, benefits, right, on the federal level, healthcare and education on the provincial level, and police and fire department on the municipal level. Okay, the Canadian tax system. Let's talk about this one. All right, and that's why when I talk to people, Canada is a land of immigrants, and going through these kind of programs enable you to understand how all these tax systems work because the tax system, okay, in every country differs. It differs from country to country, right? And that's why when we go out as an agent, we also help the people we know or we meeting with knowledge around this stuff. Okay. Now, federal and provincial governments collect income taxes and also raise money through what are collectively known as commodity taxes. This will each be addressed below. Okay, we have personal income tax. All right, personal income is the tax levied on the total income of individual net of deductions and credits. It is based on an individual's taxable income. Okay, that is personal income tax. All right. How about taxable income includes salaries and wages, commissions, rental income, net income from on unincorporated businesses, for example, self-employment income. Okay. Then we also have investment returns such as interest, dividends, and capital gains, and certain benefits. All these are taxable incomes. Okay. Now let's move on to what? The federal income taxes. Let's talk about this one. Federal income taxes are based on graduated tax rates. All right. Now, what does this mean? This means that the percentage of taxes paid increases as taxable income increases. Yes. All right. Yes, yes, yes. And thus, an individual with a higher income will have a higher tax rate than an individual with a lower income. Currently, the top federal tax rate is 29%. Corporations pay either a 10 to 5%, 10.5%, or 15% federal tax rate, with the exception of Quebec, which has a separate provincial tax return. The federal tax return for residents of the other provinces and territories includes provincials and territory returns. So the main criteria for filing a returns are: does the individual owe unpaid taxes? Is the individual required to contribute to the Canada Pension Plan or the Quebec Pension Plan? Does the individual have taxable gain? All right? Okay. So we've talked about all those ones. Now let's look at the table here, which shows us the federal tax rate for 2020. Okay. Amount of taxable income. Let's say on the first 5 days, this is what the individual pays. But if this table, you don't need to worry yourself about table. You won't be asked what is the tax rate now. Okay. And here they're telling us about Quebec, and the information here about where this source or these data are sourced from. Okay. Now we have an example here. Simon has a taxable income of $5,000. According to the federal tax table, Simon, a resident of a province other than Quebec, will pay $114 on the first 40,473. And in bracket, we have 280 plus 949 plus 885. To determine the amount of additional tax he needs to pay, he calculates 5,000 minus 0,473, which will be equal to 527. And this is achieved by multiplying 527 by 29% in order to determine the tax on his taxable income. Okay? All right. So we'll move on to provincial income taxes. Let's talk about this one. Real quick, let me see. Are there people waiting in the waiting? Okay, nobody's waiting. Now, individuals also have to pay provincial income taxes. The criteria may vary from province to province, but they are generally asked to provide information from their federal returns, including taxable income, net income, dividend income, Canada Pension Plan, CPP, and Quebec Pension Plan, QPP contributions, employment insurance EI premium, medical expenses, and donations and gifts. The provincial forms are included with the income tax package, except for Quebec, which has its own. Provincial income tax rates vary from province to province. The provinces have also graduated tax rates for individuals, as you can see in this table. Okay? This is for all different provinces: Newfoundland, Prince Edward, Northwest Territory, Nunavut, Yukon, and etc. And this information is sourced from all these links and data. Okay, let's move on to commodity taxes. All right. Now, commodity taxes include GST, that is goods and services tax, PST, which stands for provincial sales tax. And in provinces which combine the two, the GST is called HST, which is harmonized sales tax. For us in Alberta, we only pay the federal tax, which is 5%. We don't have provincial goods and services tax, and that's why our tax rate on purchases and goods here in Alberta is what? Is very minimal. But in places like BC and Ontario that have harmonized sales tax, So I think Ontario is 13%, 8% for the province, and 5% to the federal. Okay. HST combined GST and PST and only exists in some provinces. In Quebec, the Quebec sales tax allows the same rules as GST, and the QST is not harmonized and is a separate tax. Excise tax are charged on such things as fuel, inefficient vehicles, okay? Air conditioners designed for use in automobiles and gasolines. They also include excise duties on alcohol and tobacco products. Up to date information on GST, HST, and PST can be found on the Canada Revenue Agency, the CRA website. While insurance premiums are exempt from HST, some provinces can charge a premium tax on a certain types of insurance, including group insurance, and this will be covered in chapter number 3. All right, we move withholding tax. Well, withholding taxes are a payment or a prepayment of taxes owed. Okay, domestic withholding tax. Let's talk about this one. When an employee earns a salary, the employer typically withholds a portion of the taxes the employee will normally owe and submit that amount of the go- and submit that amount to the government on behalf of the employee. Withholding taxes also apply to items such as RRSP withdrawals. Okay, that is 5% for Quebec, and withdrawal of this less, anyways, whatever it is there. I don't know why they are bugging us with Quebec related matters. Okay, now let's go to foreign withholding tax. Individuals may be subject to foreign withholding tax if they receive dividends from shares of foreign corporations. All right, all right, all right. Okay. As a result of treaties, signatories countries waive or significantly reduce the withholding tax paid on income and on assets held within registered savings or income plan. Okay, which is in bracket RRSP and RRIF. There is no mechanism for the refund of withholding taxes pertaining to dividends on foreign securities held in tax-free savings account. For example, Chris owns shares in several US dividend-paying companies. He knows that there will be a default withholding tax rate of 30% if he files the right form. All right. So he will be eligible for a preferential rate of 15%. He may minimize the Canadian taxes otherwise owing on this US dividend income by claiming a foreign tax credit when he files his Canadian tax return. All right, we move on to withholding taxes on assets owned by a non-resident. Withholding taxes. 2, 3. Trying to see where I am. Hmm. Oh, okay. All right. Yeah, so I found that. Sorry about that. Okay. Now, administered on assets owned by a non-resident or payments received by a non-resident. This includes items such as annuity payments and insurance policies. So these are withholding taxes on assets owned by a non-resident. Okay. All right, so we move on to definition of a self-assessed tax system. Okay, now Canada has a self-assessed tax system. Canadians report their own income and file their own taxes accordingly. A self-assessed system doesn't mean that income tax payment is optional, but that individuals are the ones filing their taxes, their tax returns, not the government. Any taxes owing are due by the tax return filing deadline date. As such, taxpayers should and send payments for any taxes owing to Canada Revenue Agency when filing their tax return within a couple of weeks of filing. A notice of assessment is sent to the taxpayers confirming either an amount owing or a refund. If there is a refund owing by the CRA, payments will be made either by check or a direct deposit to the taxpayer's account. The Canada Revenue Agency (CRA) regularly audits or inspects a number of individuals and corporate tax returns in order to verify legitimacy. Some audits or inspections are performed at random. Others may be due to a suspicious or excessive claim. The CRA can audit up to 3 years after notice of assessment is sent. Corporations other than Canadian-controlled private corporations and mutual funds mutual fund trust up to 4 years. No time limit for fraud and blatant disregards to tax rule. Okay. Individuals are required to retain all tax-related information for 6 years. For example, an individual who filed taxes in 2015 should retain those records until at least 2021, in case he or she is audited in a subsequent year. Canada Revenue Agency audit CRA. Okay. Now, each year, the Canada Revenue Agency (CRA) audits or inspects a number of individuals and corporate income tax return (HST and GST return), as well as excise tax duties and payroll records. Most taxpayers earn salary, wages, or are pensioners. Their incomes are easily verified by comparing the information they file with the CRA with the information employers and financial institutions provide. Taxpayers who are in compliance should not be concerned about such reviews. The CRA will generally take more care to review individuals who have business or professionals' income as well as corporations and trusts. All right, there are different types of Canada Revenue Agency audits. Let's talk about that one. And then these are computer generated lists, okay? And then most returns are selected for audit reviews from computer generated lists. Audit projects, leads, and all this information are in this table. And again, because I typically blow up this my whatever, so it makes my table go out of whack, but you can go back to reference your own table. Okay. If CRA selects a return for an audit, an auditor will review the individual's corporation's trust return information and the CRA that the CRA has on file, and such as the taxpayer's returns and financial statements, and it may request specific records from the individual. When the CRA completes the audit, the auditor will issue a notice of assessment or reassessment if there are adjustments to the return. If a taxpayer disagrees with the notice of a reassessment, they can try to resolve the issue that led to the reassessment at the CRA Tax Services Office. If the taxpayer has no success at the tax services office level, a notice of objection can be prepared, and this will lead to a review by the CRA's appeal office. Beyond that appeal may be made to the court. Beyond that, appeal may be made to the court. Okay, statutory limits of audit, statutory limits of audit, audit limit of audit. All right, let's move on and talk about statutory limit of an audit. Okay, the normal reassessment period for most taxpayers is 3 years after the CRA sends its notice of assessment. Okay, the exceptions are mutual funds trusts and corporations, other than Canadian controlled private corporations, for which the normal assessment period is 4 years. After this period, the CRA is barred from commencing an audit. Similarly, a taxpayer cannot ask to have a file reopened to claim a refund. In the event of fraud, gross negligence, or a conscious disregard to tax rules, there is no time limit. All right, moving on to retention of records. Retention of records. Retention of records. All right. The Income Tax Act requires that taxpayers keep all records to verify information contained in, in filed tax returns for a period of 6 years from the end of the taxation year relating to the record. General Anti-Avoidance Rule, GAAR. Let's talk about this one. Well, the General Anti-Avoidance Rule is intended to prevent individuals and corporations from engaging in transactions that have no other purpose than to provide an inappropriate tax benefit. The CRA definition of tax benefits under the Income Tax Act is a reduction, avoidance, or deferral of tax or other amounts payable under this act, or an increase in a refund of tax or other amount under this act. The CRA discourages and prevents excessive tax avoidance through several strategies. Regular reviews for potential tax avoidance issues, monitoring current tax, avoidance trends such as tax shelters, and new legislation from the Department of Finance aimed at preventing tax evasion and excessive tax avoidance. And for more information, click on the link below. Let's move on and talk about filing tax returns. You see, if you are new in Canada, you know that when the tax season comes, right, we talk about filing taxes and all that. So if you're new in Canada and you've not experienced that before, this is a good knowledge for you guys because come next year, March is our filing season, right? So now let's talk about it. Both individuals and corporations must file taxes before the respective deadlines. Individuals who are US citizens or holds a green card also must file a US tax return. Fiscal year and tax reporting year end. Let's talk about this one. All right. For individuals, okay, file T1 tax returns based on the calendar year, January to December. Okay. Taxes are calculated and our tax returns are filed on a calendar year basis. Year end is always December 31st, and December 31st also applies to individuals who are self-employed. The CRA categorizes self-employed income as business, professional, commissions, farming, fishing income. Okay. All right. Corporations. All right. The fiscal year is a corporation's reporting period, and it is at most 12 months, but can be shorter in a corporation's first year of operations. Okay. Corporation can choose any date for their tax year end. Like for us, our corporate tax year is fiscal, not calendar. Okay. There's our fiscal year, I think, is from April 1st to March 31st, if March 30 or 31st, depending on many days that March have. Okay. All right, tax return must be filed within, okay, that we've talked about this one. So members of a partnership generally uses the December 31st reporting year to report their shares of partnership income on or losses on their T1 returns. Again, reference this table. Mine is not as good. Okay, let's talk about Canada and the United States. Oh, the taxes of here. All right. In Canada, taxes are based on residency, and in the US, taxes are based on citizenship. Hmm. All US citizens, regardless of where they live and the sources of the income, are required to file a US tax return. Many individuals live in one country but have income from another. Others may have dual citizenship or income from both countries. Tax treaties between Canada and the US reduces the possibility of double taxation on income, and Canadians who have worked or lived in the US and continue to hold assets in the form of retirement savings may need to withdraw these funds. And this is a complex process with possible option to transfer to RRSP. For example, Sam has lived and worked in Winnipeg for the past 20 years. He files his tax return every year before the tax filing deadline. Sam is also a US citizen. Even though he has not worked in the US for 20 years, he has to file a US tax return to reporting the income earned in Canada. However, Sam can claim a tax credit on his US tax return equivalent to income tax paid in Canada. The tax credit reduces the amount of US income tax payable. There you have it, how it is done. And we move to tax types of income. Types of income. Okay. A tax return has sections for total income, net income, and taxable income. Number one, types of income. There are three types of income. There's total income, we have net income and taxable income. Take note of that. Let's talk about total income. What is total income? A total income for each calendar year must be reported on a tax return, and this includes employment and pension income, disability and childcare benefits, employment insurance, Canada pension plan, and old age supplementary benefit, registered retirement savings plan, or register retirement income from RIF. Tax-exempt payments include inheritances, lottery winnings, guaranteed income supplement benefit, GIS, strike pay, life insurance benefits. All these are tax exempt. Okay, note that for an exhaustive list, consult the General Income Tax and Benefit Guide on Canada Revenue website. And there you have it. And for us, we move to the next one, which is what? Net income. Okay. Net income is total income less specific deductions. And net income begins with total income and lists the items, expenses, and contributions that are deducted from it, which are common deductions are RRSP, which is Registered Retirement Savings Plan, or RPP, okay, contributions, childcare expenses, disability support, business investment loss, moving expenses, support payments, excluding most child support payments, carrying charges, and interest expenses, Canada Pension Plan CPP contributions on self-employed earnings, social benefit repayments required on provincial territories, tax returns, and is issued for calculating child tax credit, VST /ACST credit. All right, and that is pretty much straightforward. Let's talk about total income. All right. Now, so we talked about taxable income. We've talked about which is types of income. We've talked about total income. We talked about net income, and now we are talking about what taxable income. Now, taxable income is net income after additional specific deductions, and the specific additional deductions include Canadian Forces personnel and police deductions, employee home relocation load deductions, security options deductions, other payments deductions, limited partnership losses of other years, non-capital losses of other years, capital gain deductions, not all resident deductions, and additional deductions. Now, taxable income may be required on provincial territories' tax forms and is used for calculating federal tax. Okay, so and there we have it. And this time we are moving on to marginal and average tax rates. Okay, what is marginal tax rate? Marginal tax rate is often described as the amount of taxes owing on an each additional dollar of income earned. Okay, tax rates are divided into tax brackets. As income increases, additional what? Additional income is taxed at increasing tax rate. For example, Margaret has taxable income of this, and the federal marginal tax rate for taxable income over 630. But more than that, it goes up. Now, for this, I would just recommend just Google marginal or tax rate in your province. You can Google tax rate in BC, tax rate in Alberta 2023, tax rate in Ontario in 20. In your Google that, and you're going to see the way it's being cascaded. So you will see that the higher you earn, the more taxes you pay on the additional end income. Okay. The calculations for excuse me, the calculations for marginal tax rate is equal to federal tax rate plus provincial tax rate. Pretty much straightforward. The marginal tax rate is federal tax rate plus, okay? Average tax rate is a percentage of each dollar of income paid as tax, okay? So average tax rate equal to tax paid divided by income earned. So whenever you see average, you are dividing something, okay? Say, for example, you put 6 items. So you put 6 numbers. You said, okay, 1 plus 2 plus 3 plus 4 plus 5 plus 6. All right. The average of that number over 6 months is adding all the 6 numbers together and dividing it by 6. So if I want to take average of 1 plus 2 plus 3 plus 4 plus 5 plus 6, that will be, I'm just pulling out my calculator here. That will be 1 plus 2 plus 3 plus 4 plus 5 plus 6 gives me 21. And I got to divide it by what? 6. And I have 3.5. So when you hear average, average speaks to division, dividing. Okay. So now average tax rate, now you see division of tax rate, okay, is equal to, just know that when you hear average, you are going to be dividing. Okay. So that the tax is paid divided by the income earned. So the income you earn is at the bottom. The taxes you paid is on top. Okay, the taxes paid divide by the income earned. Okay. And you can see that in this example. All right. And for the most part, it's going to give you your answer is likely going to be in percentage. Okay. Now let's talk about differences between deductions and credit. Okay. What are the difference between deductions and credits? Let's talk about that one. Deductions and credits are not the same. Okay. Deductions and credits are not the same, but both helps to reduce the amount of taxes an individual must pay. Okay. Deductions reduce the income that is used for calculating taxes owed. One of the most common income tax deduction is RRSP deductions. Very true. Every dollar contributed to an RRSP reduces the net income taxes that you pay. I give you an example on my own. Okay. And for those of you that I've met with, I give this example all the time. For example, when somebody is earning 100,000 and that individual contribute 20,000 into their RRSP, okay, that 20,000 they contributed is going to be a tax deduction, is going to reduce the amount of taxes they will pay because their taxes is taken on 100,000. So they are going to minus that 20,000 for their 100,000, bringing their taxable income to what? 80,000. Okay. Okay. Let's move on to tax credits. Federal and provincial tax credit reduce federal and provincial taxes owing. In other words, tax credit reduces tax payable. For example, each taxpayer claims $229 in 2020 as a personal amount, while people 65 years old of age or older with income below 508, this is not 508, I think in thousands, okay, claims additional age amount of this. Okay, this amount is adjusted downward according to income. Now, the federal non-refundable tax credit rate is 15%. So provinces also have a system of credits that reduce provincial tax. Refundable and non-refundable tax credit, okay? Some credits are refundable. For example, GST, HST tax credit is a tax-free quarterly payment to low modest income individuals and families. Most tax credits are non-refundable, meaning that they cannot reduce tax payable below zero. And if the credits cannot be used, it will be lost. Okay. Some of the most common tax credits include labor sponsored funds tax credit, labor-sponsored fund tax credit is available at 15% of the contributions up to a maximum of zero. Pension income tax credit is available up to the maximum of this number. For those reporting eligible pensions, then superannuation or annuity payments, wherever that is. Okay. Okay, we move on to tax reporting in the year of death of a person. Okay. You know, when somebody dies, they still file their final taxes. Okay. So that one is what we are discussing now. When someone dies, a legal representative is responsible for administering the estate of the deceased. They include a specific responsibilities pertaining to the CRA and Service Canada, such as provide CRA with death, deceased date of death, cease or transfer certain benefits payments such as CPP, and filing tax returns and making sure taxes owed are paid. Up-to-date information, please refer to CRA website, okay? Rules that a legal representative must comply with following the death of a person. Wow, what are the rules? What are the rules? The legal representative is responsible for administering the deceased estate and carrying out the distribution of the estate asset as stated in the deceased will. The legal representative must provide the CRA with the date of death of the deceased. Or I seize or transfer, in some cases, certain benefit the deceased was receiving. Now, if someone dies between January 1 and October 31st, their final tax return is due on April 30th of the following year. If someone dies between November 1 and December 31st, their final tax return is due within 6 months of the date of death. If someone dies after December 31st, but on or before the due date for the return, General April 30th, then the due date for filing the deceased and the surviving spouse or common law partner's return is 6 months after the date of death. If the deceased was self-employed or was married to a person who is self-employed, slightly different due dates may apply. The tax returns of the surviving spouse who lived with the deceased has the same filing date as the deceased rather than the April 30th filing date. However, any tax owing must be paid by April 30th to avoid interest charges. The legal representative is responsible under the Income Tax Act for the following: filing all required returns for the deceased, making sure that all taxes owed are paid, letting the beneficiaries know which and if any of the amount they receive from the estate are taxable, and obtaining a clearance certificate to certify that all amount owing to the CRA have been paid. Any fees paid to the legal representatives or the administrator are reported on a T4 slip unless included in that person's business income. For up-to-date information, please check out on CRA website. Definition of probate. What is probate? Probate is the process through which a will is certified to be the deceased last valid will and through which an estate executor in turn receives approval from a court to obtain and distribute assets. Whether a will go through probate depends on specifics and varies among provinces. Probate fees, with the exception of Quebec, are administered based on the size of the estate, that is a fair market value of the assets passing through the will. Probate fees varies considerably by province. Life insurance death benefits paid directly to a named beneficiary, that is, the beneficiary is not the estate, are not subject to probate. I don't care about what Quebec has, please. Estate taxation. Let's talk about that one. A deceased individual's estate is taxed based on the principle of deemed disposition. In other words, for tax purpose, taxes are administered as if the individual has sold all his or her assets on the day of death after at a fair market value. Spousal deferral. I told you guys this one. Sarah is very patient. Yeah. So for this one, a spouse means married spouse or common law partner or a partner including same-sex partner. An exemption to this is a spousal rollover, provisions that permit assets to be transferred to the surviving spouse at the adjusted cost basis of the deceased and obtained at the same court. Under the spousal rollover provision, the deceased will not be taxed on the assets. Ownership will roll over to the surviving spouse only upon the death of the surviving spouse would the tax liability be assessed and become owner. The adjusted cost basis ACB referred to the cost of an asset for the tax purposes. It is generally equal to the sum of the purchase price plus expenses incurred to make the purchase, plus expenses incurred to sell the asset, less the sum of the capital distribution received. You can go through the example here. Okay, we move on to rollover to dependent children or grandchildren. Okay, the fair market value of an RRSP is generally included in the deceased income for the year of death. You see, and this is the part that makes me that we need to talk to people a lot, because you see, all of us, almost everybody in this country own one property or the other, or even several. Because if we don't tackle this part very well, yes, spousal rollover exists, but when that access flows to the next generation, which is now our children, it's going to trigger a lot of taxes for them to pay. Okay. However, if an amount is paid from the RRSP to a financially dependent children or grandchild, the amount reported on the deceased final return is reduced by the amount, and a T4RSP slip is issued to the child or grandchild, who then report it as income. Okay? Financial dependence will require the child or grandchild to have income less than the personal amount. If the beneficiary is a dependent of the deceased due to mental or physical infirmity, then the RRSP proceed may be rolled over tax-free into an RRSP or a registered disability savings plan (RDSP) in the beneficiary's name up to his available RDSP contribution rule. And finally, a dependent child or a grandchild under the age of 18 is entitled to a rollover of the RRSP refund of premiums to an annuity for which the child is the sole beneficiary. The annuity must be for a number of years, not exceeding 18, minus the age of the child at the time of its acquisition. Okay? So we move on to the next, which is understanding how individuals are taxed. Employers deduct federal and provincial tax from each employee's gross income and submit to CRA on behalf of the employee. Okay? The amount deducted is a credit against the employee's taxes otherwise payable. If due to the impact of deductions and tax credit, the tax otherwise payable turns out to be less than the amount deducted, then the taxpayer will receive a refund when he or she files a tax refund. Employers also deduct Canada Pension Plan CPP or in Quebec QPP, wherever. Okay, why are you guys telling us about Quebec? All right. Okay. Telework deductions in connections with COVID-19. An employee can deduct from employment income, home office rent, and cost of supplies that we consume directly in the performance of their duties, that is their home office. If these outlays by the employee were required by a contract of the employment, the principal condition for the deductions of expenses in the respect of the workspace at home, such as rent, utilities, and maintenance costs, is that the employee must principally perform, that is more than 50% of his work from that workspace for more than 6 months out of the year. To claim deductions for home office expenses, the employee must file a Form T2200 with the employee's personal tax return. In the context of COVID-19, an employer may reimburse an employee for the purchase of personal computer equipment up to this amount, and such reimbursement would not be a taxable benefit to the employee. For up-to-date information, check out CRA website. All right, we'll move on to working on commissions employment. Okay, for those that um they are not employees, they don't receive salary, but they get paid for commissions. Okay. Salaried employees typically have a very few options available for deductions related to employment expenses. However, commissioned employees, as opposed to salaried employees, are usually entitled to more deductions, such as those related to motor vehicles and home office expenses. Okay. How about self-employed? Well, self-employed individuals can deduct business expenses such as insurance premium, interest, management and administration fees, maintenance and repairs, rent, property taxes, travel and fuel, professional fees, for example, legal or accounting services, salaries and wages, and business out of home costs. Example, Cho runs a petty business out of his apartment where he uses one room as a studio, which amounts to this. Okay, you can complete reading the example. Okay, we talk about business owners of businesses, owners of business. All right, for business owners, how does this work? Well, business owners of corporations can pay themselves in salary or dividends, which may result in a more favorable tax treatment or a combination of both. Brenda, a corporation, had this amount of profit after tax last year, and this money is now available to buy new equipment to expand the business. As she become being a sole proprietor, she will have had a fewer funds after tax for exemptions. Okay. Anyways, depending on which province the corporation operates, okay, in and assuming it's eligible for the small business deduction, it will have a tax rate between 11% to 23%. Okay, and in some province and several provinces, 15.5%. Let's talk about trust. Trusts are legal structures which are also subject to taxation. There are different types of trust. Number one, testamentary trust. I say trust. Testamentary trust created on the day a person dies. Okay, like testament. Okay. For example, Amos is a widower with 4 children, ages 4 and 8. Sorry, with 2 children, ages 4 and 8. He changes his will to establish a testamentary trust with his children as the beneficiary and 2 of his brothers as trustees. Prior to 2016, testamentary trusts were taxed federally using the same graduated tax rate as individuals. However, following the change for 2016 and subsequent years, this is limited to 36 months for estates, and after which it will be subject to the top marginal rate graduated tax rates continue to for trusts whose beneficiaries are eligible for disability tax credit. Then the next one is intervival trust. So we have testamentary trust and intervival trust. What is intervival trust? created during an individual's lifetime, taxed at the highest marginal tax rate at the rate of 33%. RRSP accounts and segregated funds are trusts held by a trustee, the institution that holds the assets for the beneficiary, for the benefit of beneficiary. Then we have real estate income trust, holds real estate property for the benefit of unit holders. Then we have mutual funds. Most mutual funds are trusts, few are structured as corporations. For up-to-date information, check this link. Understanding how income taxes can be deferred or avoided. Okay. Tax evasion is illegal. It can mean failing to report all income or making fictitious deductions. It is perfectly legal to avoid or defer some taxes, in bracket tax avoidance, through proper financial planning. Tax advantages of government programs or using strategies to minimize the tax burden. Okay, tax planning is an important part of financial planning to maximize tax deduction. And the strategies we could use for this is TFSA, RRSP, and RESP accounts. This and now we have a new program now called First Time Home Buyer Savings Plan. Okay, these programs these are government approved programs that provide tax sheltered investment growth. And the use of these programs will thus result in lower taxes. We can read this example. Okay. When to refer to a tax expert. Okay, we are not tax experts, and it's important for us to know when to send our clients to the experts, not assume the role of an accountant. Okay, life insurance agents should have a basic working level taxation knowledge, but are not experts in all areas of taxation. There are many complex circumstances that require an advanced level of tax knowledge, where the agent should refer the client to a tax specialist, such as the accountant, a tax lawyer. For example, we can read this example here, my friends. And that brings us to the end of chapter 1. So we're going to continue to chapter 2, but we'll take a 10-minute break. When we come back, we continue. All right, welcome back, and we move and make progress now to chapter number 2, where we will be talking about investment income under the taxation principles. Okay, so now employment income is the primary source of total income for the most individuals. However, if an individual has invested money in an investment fund, or rather buy or sell shares or property, they may receive investment income. That's pretty much very true. All right. Now let's talk about taxation of investment income. So this investment income, how are they taxed? That's what we're talking about in this section. Okay. Investment returns are taxed in different ways, depending on how the returns are generated. Okay. Interests are taxed 100% inclusion, that is taxed the same as regular income. So that is interest, okay? That interest is taxed 100% similar to that of income. Excuse me. However, capital gain tax, remember we've been talking about, capital gain tax, it's been a word and term that we've been using since the beginning of this program, or in this course rather. So by now, that's shouldn't be new to you. And 50% inclusion rate, only half the capital gain is taxed, and this is called a taxable capital gain. What this is saying is that if somebody make the capital gain of somebody is $1 million. Okay, if you make profit through your capital, which is your capital gain is 1 million, you're not going to pay taxes on 1 million. You will pay tax on 50%, 50%, pardon me, 50% of that 1 million, which is 500,000. So you pay taxes on 500,000. Okay, and this is what this means: 50% inclusion rate. That is only half the capital gain is taxed, and this is called the taxable capital gain. And you can see an example there, so you can read that up. So we move on to dividends. Okay, dividends from Canadian corporations enjoyed preferential tax treatment via the dividend tax credit. If investment income is earned in a registered retirement savings plan, such as RRSP, okay, and registered pension plan, RPP, or a deferred profit sharing plan, RDSP, right? All income is taxable, including the capital invested, as the capital invested reduces the taxpayer's taxable income. So if investment is in a registered education savings plan, RESP, only the growth in the plan is fully taxable when the funds are withdrawn. This is because when the investment was made, it will have been with after-tax dollars. Note that with registered plans, the taxation of the income earned on the investment, that is the growth, is tax deferred until such time that it is withdrawn. And thus, the income does not have to be declared until it is withdrawn. Agents need to understand how investment income is taxed because it will help them develop insurance and investment strategies for their clients. Okay, so the next one we're going to be looking at is accrued interest. Accrued interest. What is accrued interest? Interest, interest income is fully taxable if in the year that it is received. Some investments do not pay out the interest income annually, but instead let it accrue until maturity. Even though the interest income is not paid out, it is taxable annually as though it had been paid and must be reported. Wow. This is true for investments in all accounts except registered accounts, for which the taxation of income is tax deferred until it is withdrawn. At such time, the income plus the principal invested is fully taxable. Okay. Now we are moving on to dividend income from Canadian corporations. Oh. Oh my goodness, you can stretch too. Okay, I've been sitting down. Yeah, you can stretch. Okay, we move on. So there's an example here that we could go through. You can go through this example, okay, because I want you to read it and, you know, dividend income from Canadian corporations is taxed at a lower rate than interest income. In other words, they get a preferential tax treatment. They get a preferential tax treatment. Dividends are paid out to shareholders from the after-tax profit of the corporation. So the amount paid to the shareholder has already been taxed in the hands of the corporation. So the shareholders then needs to pay tax on the dividend. This leads to a situation of double taxation because the government has already collected corporate taxes on the amount. In order to mitigate this situation, the government requires the taxpayer to report the gross up amount of the dividend received And this is the taxable amount and reflects the amount of pre-tax income. Then the corporation is presumed to have earned. So the amount of the gross up depends on whether the dividend is an eligible dividend. And those received from public companies or a non-eligible dividend, those received from private corporations and those received from private corporations. Eligible dividends, such as those paid by public companies, are grossed up by a higher amount, which is 38%, than a non-eligible dividend, some called ordinary dividend, and these ones are 15%. Therefore, the taxable amount, however, is reduced by the federal dividend tax credit eligible dividend for eligible dividends. Can say that. And for ordinary dividend is this amount. So the provinces each varying dividend tax credit. Similar provincial tax credits are available for both eligible and non-eligible tax credits. So the rates varies depending on your province. Okay. A dividend paid by a Canadian-controlled private corporation, CCPC, from its small business deductions, SBD, income or investment income is an ordinary dividend and its treatment is slightly different, as you can see in this example. Okay. There are other types of dividend. And what are those? In addition to the dividend discussed above, an agent may run into terms such as capital dividends and capital dividends account, CDA. Okay, the CDA is a theoretical tax account which a private corporation uses to keep track of the tax-free account it receives. Amount received such as tax-free death benefit from a life insurance policy where the corporation has been named a beneficiary, less the policy's adjusted cost basis or a non-taxable portion of the capital gains are credited to CDA. Okay, the corporations can then distribute the amount in the CDA to shareholders as tax-free capital dividend. Example, Martina is president of a small corporation whose shares are owned by her children. The corporation is the beneficiary of the term insurance policy on her life. Martina dies as the proceeds, and the proceeds of the policy are paid out to the corporation and applied to the capital dividend account, which is CDA account. They are distributed tax-free to the shareholders, which in turns are the children. Okay, so this is one of the big value proposition that we can sell to small business owners, right? Small business owners can take life insurance on themselves and have their business be the owner and pay the distance so that when the death benefit is paid to the CDA account, and from there is distributed to the children tax free. So what the small business owner was able to do is that the small business owner now was able to maybe take a huge policy and also have the business pay the premium. Okay. All right. So we move on to dividend income from foreign sources. Dividend income from foreign sources. How is this one treated? Let's talk about it. Dividend income received from foreign sources does not receive the dividend tax credit. Wow. Okay. They are taxed the same way as interest income. Wow. Withholding taxes on foreign income. Withholding taxes on foreign income. Investors who receive dividends from foreign corporations may have tax withheld when paid. The amount of withholding tax depends on the foreign country. So tax strategies between Canada and most other countries help offset the tax liabilities on the dividend by the way of a foreign tax credit, which credits the withholding tax already paid in the foreign country against the tax owed. As a result of these treaties, most countries waive withholding taxes on income paid from registered savings plans such as an RRSP or RRIF. However, there is no mechanism for refunding withholding taxes pertaining to investment in the TFSA account. Investors should consider the potential impact of withholding taxes on dividends paying foreign investments in their TFSA. Okay, so we move on to capital gain, that is disposition of capital assets. Disposition of capital assets. All right, how does this work? Well, a capital gain occurs when an investor, that is individuals or corporations, sells a capital property at a price higher than its adjusted cost basis, ACB, and this resulting in a capital gain for its tax purposes. So a sale of a capital property may also result in a capital loss if the property is sold for a value less than its ACB. Currently, 50% of capital gain are taxable. That is, capital gain have a 50% inclusion rate. That is, if the capital gain, again, same thing, capital gain is 500,000, then the taxable part of it is 50% of that, which is 250,000. As you can see that in this example. Okay. Moving on, capital property is any property held outside of a registered account which the taxpayer invests with a view of making income. Capital property includes cottages, rental properties, buildings, and equipment used in a business, stocks and bonds, mutual funds, segregated funds, etc., held outside a tax-deferred account. So please know that a capital gain is triggered by a sale of the capital property. While the capital property is being held by the owner, no capital gain is triggered, although the capital property might be appreciating in value. Therefore, accrued capital gains are not taxed annually. Only the realized capital gains on the disposition of the capital property is subject to tax, and hence investment in capital property may provide a means of tax deferred to an investor. This is pretty much straightforward, right? You bought a house, 500,000 is now 2 million. So long as you're still keeping the house and the house is not yet sold, it does not trigger capital gain. You're not expected to report the appreciation of your capital property, capital investment on your tax returns. No. Okay. So you enjoy that capital appreciation deferred until the asset is sold. That's when you will have to declare the capital gain. Okay. That's pretty much what this is talking about. A capital property need not be sold to trigger capital gain tax. A deemed sale occurs if an individual exchanges one property for another, gifts a property. If the property is stolen or destroyed, a person emigrates from Canada and upon the death of the property. So now, so what is telling us is a capital property need not be sold to trigger capital gains. Okay, even when you gift it to somebody, it's also deemed as disposition. It's deemed that you have sold it. You understand? You still have to report that. Okay, personal property. All right, personal property. Well, the disposition of a personal property does not trigger a capital gain or loss. Personal property is a property owned by a person and used for his or her own sole pleasure without intention of making any income on the property, such as a boat, or an automobile, household furniture, clothing, etc. The CRA assumes that each of these properties has an adjusted cost basis of this and holds that most personal property depreciates over time. We can see that example here. Okay, listed personal property. Well, the exceptions to these rules are listed as personal properties and include prints, etchings, drawings, paintings, sculptures, or other works of art, jewelry, rare folios, manuscripts or books, stamps, coins, etc. Net gains and losses. On these must be reported on tax returns, although losses on listed personal property may only be deducted against gains from listed personal properties. So, in other words, you cannot deduct loss on listed properties from gains of uh, capital. What are those other ones now? Other investment properties or capital properties. Okay. Now let's go on to rules pertaining to capital losses. What are the rules? Okay. Similarly, capital losses occurs when an investor sells a capital property for a price less than its ACP. And we can see that is this example. We all know loss is when, your whatever, you sell something at a lower price compared to what you bought it. Okay. Then we move on to talk about offset rules. Okay. Offset carry forward and carry back. Now, allowable capital losses must be applied against taxable capital gain for the current year to offset all or part of the gains. If losses still remains, it becomes the taxpayer's net capital loss, and which is the difference between the allowable capital loss and the taxable capital gains for that year. A taxpayer can carry back the net capital loss to reduce or eliminate capital gains, if any, of the three immediate prior tax year, or carry the loss forward into the future year. When carrying forward net capital losses from the previous years to be used in a current year, the taxpayer needs to be cautious of the fact that the capital gains inclusion rate may have changed and thus will need to make an adjustment. Hmm. Wow. In the notice of assessment, CRA provides the adjusted net capital losses that are carried forward and which may be applied against capital gains in the current year. When carrying back net capital losses, no adjustments are needed. At death, capital losses may be applied against all sources of income of the deceased and not just the capital gains. Superficial losses. Superficial. Which one is superficial losses? Oh dear. Superficial losses. Let's talk about this one. Active investors in the stock markets regularly review their trades for the year and forward. And towards the end of the year, they sell off some of their investments that are trading below cost. So they can use the losses to offset capital gains earned during the year, thereby reducing their taxes. In some cases, the investors may want to buy back the investment that they were sold at loss. Therefore, if the investor buys back the investment that they sold for a loss, immediately the loss from the disposition will be deemed a superficial loss, and the investor will not be able to use the loss to offset capital gain for that year. Really? Wow, this is interesting. A superficial loss occurs when an investor sells a capital property at a loss. So therefore, the investor or a person affiliated to the investor buys or had the right to buy. So therefore, the same or identical property called substituted property within a 61-day time frame from 30 days before the sale to 30 days after the sale, and the investor still owns or has the right to buy the substituted property 30 days after the sale. And if the investor is the individual acquiring the substituted property, then the investor can usually add the superficial loss amount to the adjusted cost basis of the substituted property, and thus either reducing capital gain or increasing the capital loss when the substituted property is sold. Wow. Hmm. Let's move on to tax deferral. Tax deferral. Because of the time value of money, it is quite often efficient to defer taxes as much as possible. A good example of this is the RRSP plan. So we've talked about it a lot and we've analyzed and explained, you see, how the RRSP provides a great strategy for tax deferral. Okay? Unlike accrued interest, which is taxed annually, increases on or declines in the value of an investment known as paper or unrealized gains and losses are not reported for tax purposes until the year in which the asset is actually sold or deemed sold. At the time of sale, there is a realized or actual gain or loss. Okay, we can see that in this example. Tax-free capital gain. Let's talk about that one. There are exceptions to the taxation of capital gain. Some capital gains are tax-free. A notable example is the tax exemption given to capital gains on the individuals or family unit principal residence. Yeah, it's tax-free capital gain. Anyways, tax-free capital gain on principal residence. Well, the capital gains on a principal residence are tax-free in Canada. Only one principal residence can be owned at a time for family units, which includes spouse and children under 18 years of age. The principal residence can include a house, condominium, cottage, houseboat, mobile home, trailer, and an apartment unit in an apartment building or duplex. Valuation Day Rule 1982 changes and 1994 capital gain elections and implications. Okay. Do, 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 do. Prior to December 31st, 1971, capital gains were not taxed in Canada. This changed after 1971, and SCP for public traded shares was established using fair market value so December 22nd, 1971. And for other assets, the ACB was the fair market value as on December 31st, 1971. However, a principal residence will remain exempt for taxation. At that time, the principal residence exemption was given on a per individual basis. This means that couples could own two principal residences and utilize the exemptions provided they were not jointly owned. This ended in 1982 when the rule changed to one principal residence at a time per family unit. As a result of the change, a couple could now only own a one principal residence. Couples were advised to determine the fair market value of the home as of December 31st, 1981 to have a base against which to measure future gains. The rule changed again in 1994 when the federal government eliminated the lifetime capital gain exemption, LCGE, of many individuals with second residence, applied any unused exemption to their second residences to raise the ATP. And from an insurance perspective, many families who owns a second residence and wants to pass it on to their children and or grandchildren use life insurance to pay the tax or taxable capital gains at death. Wow, interesting. We move on to small business exemptions and farm exemptions. Small business exemptions and farm exemptions. Let's talk about that one. Okay. There is an LCGE applicable to qualified small business corporations shares, working farms, and qualified fishing property. The purpose of the exemption is to make it easier for people to pass their businesses, their farms, or their fishing properties to the next generation. Qualified farm or fishing property disposed of after April 22nd, 2015 are eligible for additional deductions, effectively increasing the lifetime capital gain exemption to 1 million for QFFF and then indexed to inflation since 2014. The LCGE for small business non-farm fishing is this amount in 2020, which means a capital gains deduction of up to 441,692. Okay. Taxation of rental income. Let's talk about this one. All right. Um, Rental income is taxable. Some of the assets associated with maintaining a rental properties are tax deductible, such as legal accounting and other professional fees, maintenance, upkeep and repairs, office expenses, insurance, and property taxes. If the rented space is within the taxpayer's home, certain expenses such as property tax will be limited to the reasonable percentage based on the number of rooms or square footage area rented out. Net rental income is considered end income for the purpose of RRSP contributions. Okay. Exceptions, exemptions, an adventure or concern in the nature of trade. The CRA position is that if an individual does something that produces a profit on a regular basis, it is not considered capital gain, but income. The phrase the CRA uses is carrying on a trade or business, notwithstanding that these activities may be quite separate and apart from its ordinary occupation. An example is that if a dentist who habitually buys and sells real estate, in some circumstances, this rule can also apply to buying and selling securities. Okay? For example, Karen quit her job to become a day trader. Last year, she had more than 500 trades, and she had profits for some and losses for others. Overall, she had a net profit of 5,000 after transaction cost. Because this is her full-time occupation, the CRA is likely to take the view that Karen is in adventure or concern in the nature of trade, and the 5,000 business income against which she can deduct office and similar expenses are not capital gains. Corporate structure and taxation. So we're moving on to start talking about this one now. Many small businesses are structured as a corporation. So when a business owner incorporates the business, it is a separate entity legally and for tax purposes as well. The advantages of incorporations include limited liability, opportunities for income splitting through a share structure, ability to retain income in the corporations and invested by the corporation, lower tax rate for corporations than individuals. Disadvantages of corporations include greater regulation, record keeping, higher legal costs, and accounting costs. Flat tax rate. Unlike individuals who have a graduated tax rate structure, corporations have a flat tax rate. For a Canadian controlled private corporation, the federal tax rate is 9% in 2020. Provincial tax rate ranges from 4.5% and 5% in Quebec. Using a corporation to meet income splitting demands. Corporations can pay dividends from after-tax profit to their shareholders, and the share structures of the corporations can be tailored to provide income splitting amongst shareholders. For example, a spouse within a lower marginal tax rate could subscribe to shares in a company run by the other spouse. Because the spouse is in a lower marginal tax rate, they will pay minimal tax on dividends received on the shares. Holding companies. An agent may have clients who have investment in holding companies, with the holding company being used alongside an operating company and holding the shares of the operating company. Like with other corporations, this arrangement has cost implications in the form of filing financial statements and corporate tax returns. These costs can be significant relative to the income earned, and these holding companies that will let's talk about that one. Mutual funds and segregated funds are structured as trusts and avoid taxation by flowing through all interest, capital gain, and dividends to, let me take that again, please. Pardon me. Mutual funds and segregated funds are structured as trust and avoid taxation by flowing through all interest, capital gains, and dividends to unit holders, in bracket, the investors that owns the funds. Okay. So this is speaking to, like, you see, mutual funds, like segregated funds, all those are held in trust. Okay. Now the rule is that either the trust pays the taxes on the income or the income flowed through the individual investors who pay the taxes. These funds flow through net interest income, eligible dividends, and foreign dividends to the investors. Mutual funds flows through the net capital gains, and in the case of segregated funds, through capital gains and capital losses. So the funds issues the relevant tax slips to investors. Okay? Arm's length and non-arm's length transactions. An arm's length transactions occurs between parties that are non-related, while a non-arm's length transaction takes place between the related parties. So the Income Tax Act IT is this, that related persons shall be deemed not to act at arm's length with each other. regardless of how they conduct business. Related persons include blood relations or relationships through marriage. Okay, the ITA also states that a corporation owned by a person will be related to another person, including a corporation in which the person has a controlling interest. Hence, a corporation will be related to a person if that person controls the corporations, if that person is a member of the related group that controls the corporations, and if that person is related to a person as described as, as described. And this leads to various corporate dealings that will not be considered arm's length transactions. So these definitions are important because special tax rules applies to transactions between related persons, such as between spouses or between a corporation and its president. For example, an interest-free loan given by a corporation to its president will be considered a taxable benefit to the president. If the company charges the president If the company charges the president the prescribed interest rate for the loan, no taxable benefit will arise. Okay, the prescribed interest rate for shareholders is published quarterly by Canada Revenue Agency, and that is currently sitting around 1%. Okay, therefore, now we are moving on to spousal and common law relations. Spousal and common law relations. Okay, we're making progress, and I love that. Married couples and common law couples have property rights that vary from province to province. A province may consider that married spouses have equal interest in the family residence, even if the residence is owned and was paid for by one of the spouses. The same may not apply to common law spouses. In contrast, in common law situations, that same province may hold that only the registered owner of the family home has the property right. Okay, rights on relationships break down. So what happens when relationships break down? Property accumulated during the marriage or relationship will be divided equally among the divorcing and separating spouses, subject to any prenuptial or postnuptial agreement. Property acquired prior to the relationship generally remains with that person, as do any inheritance and insurance benefits received. Tax experts usually advise the couple on the most tax efficient way to achieve the division of their assets. Let's move on to tax implications on relationship breakdown. The tax implications can be complicated, especially if it involves spousal support and child support payments. An agent should refer clients to tax and legal specialists to speak on these matters. Generally, spousal payments are tax deductible to the payer and taxable as income to the recipient spouse. Payments for child support are not tax deductible, nor are they taxable. Hmm. If equalization payments are required as a special transfer of RRSP, RIF, or pension assets can be made using Form T2220. Note that the agent should refer a client to a tax and legal specialist to speak on this matter. Okay, we move on to tax implications upon death. How does this work? Assets owned by a deceased spouse generally can be transferred to the surviving spouse without tax implication. The surviving spouse will assume the deceased spouse's adjusted cost basis for the transferred assets. And the surviving spouse will be able to transfer the deceased spouse's RRSP or REEF as a tax-free refund of premium to their RRSP or REEF or buy a registered annuity. Okay? Proceeds of a life insurance policy with the surviving spouse as a beneficiary will be received tax-free as would any beneficiary. All right, so we move on to that one is pretty much straightforward. So that's why I'm not like, dwelling on trying to explain. There's really no need to explain what is already like straightforward like that, right? So we move on to income attribution rules. Okay, and the first one we're going to be looking at is income attribution rules as it applies to spouses. But first of all, let's talk about what is income attribution rules. Well, income attribution or income splitting is a method of reducing overall taxes paid by a family unit by transferring income from a higher marginal tax rate family member to a family member that has a lower marginal tax rate. CRA has implemented income attribution rules to prevent income splitting between spouses and other family members. Where attribution rules apply for property given to a family member, the first generation income earned on that property is attributed back and taxed in the hands of the giving family member. Any second generation income, that is income earned on reinvested income, is taxed in the hands of the recipient income earner. Okay, so let's see how this works between between spouses. Okay, the attribution rules pertain to zero interest mode, transfer of property and gift, which could be used as an investment. Okay, and I will encourage you to kindly read this example. Okay. However, attribution rules would not apply if the spouse making the loan charges the other spouse interest at rates at least equal to the prescribed rate, and provided the interest is collected by 30th January each year and reported as income on the lender's tax returns. Wow. Again, we have an example here to be read. Now let's look at income attribution rules between parents and minor children or grandchildren. Okay, parents or grandchildren can give monetary gifts to children or their grandchildren, their nieces and nephews. If these funds are invested, attribution rules apply, but in a manner different than that applicable to spouses. Any interest or dividend earned by the children are attributed back to the parents or grandparents. Capital gains or losses are not attributed back and are taxed in the hands of the child or grandchild. This is interesting. Okay, now let's look at interest and attribution rules when it comes to between parents and adult children and grandchildren. Okay. Any monetary gift given to adult children or grandchildren by parents or grandparents and theirs are no attribution rules, and there are no attribution rules applied to gifts. However, if zero interest loans are involved, attribution rules do apply to income splitting between adult children or grandchildren and parents. Again, charging an interest rate of at least the prescribed rates prevents the application of attribution rules. Okay? Mhm. tax treatment of income stemming from below market loans to spouses. The exemption to the attribution rules is dependent on the loan to the spouses having interest charged at a commercial rate or a prescribed rate. The prescribed rate is tied to Treasury bills rate, and the prescribed rate is currently 2%, second quarter of 2019, but has been higher in the past and is subject to revision by CRA or on a quarterly basis. And that brings us to the end of chapter 2, which is where we are going to stop for this morning. And in the evening, we will complete the principles of taxation by rounding up with chapter 3 and chapter 4. Thank you very much.